right? Perhaps it looks like it's going to come sooner rather than later. The 18,200.
Next week then. I mean, 300 points. I mean, this is as strong as they come, and it's looking good. I mean, the Nifty IT there's been so much up and down and so much debate, and whether this is getting very fast into a buyable kind of zone. But now Friday to Friday, and we're just starting the day, so things could change. But we are up. We are up another 1.33% this week so far, after last week's 3.5% move. So these are extremely profitable, high-quality companies, and they remain the most bombed-out space relative to other sectors which have picked up. There's not really been too much pickup, but they also are, occasionally hurt by this constant stream of slowdown and recession and all that talk coming from the US. So it's been a story of a little ahead and a little back as well. But let's put some of these points to Saurabh Mukherjea, who's our market master today. He's founder at Marcellus Investment Managers. Saurabh, great to have you with us here. Thank you very much for your time. So let me ask you straight away with regards to IT services. I mean, the index is up strongly today. How do you assess prospects for this group of stocks from a medium to long-term perspective from here, from these levels?
Well, look, Prashant, I've been saying for several months, I don't understand why anybody was circumspect or bearish on IT. It doesn't make any rational sense to me. It's like trying to time the steam engine demand cycle in the middle of the industrial revolution. For obvious reasons, these companies are doing well. Not just our holding TCS, but other companies like Infosys are doing very well. I think even HCL Tech had healthy results, and I think that will continue. The West is only 1/3 of the way through the shift to cloud. There's tons of work to be done, so it doesn't matter what the GDP growth in America or Sweden or UK is. The Indian IT services companies will carry on getting plenty of work, and on the back of that, they'll post healthy results for many years to come. So I really was bemused when, through spring and summer, some people started turning bearish on IT. It made more logical sense to me.
Okay, but what does one do now? Saurabh, hi, good morning. Because, we still have a long way to go before all the IT numbers come through and you get a proper sense of which way things are headed. There's also the US recession, inflation, etc. So there are risks on the horizon. Do you buy now, or is it still wait and watch mode for IT?
So first point, I think for everybody to get clear in their heads, the US recession has historically been a positive thing for India, right? So if you look back at the last 40 years, we've never had a stock market boom in our country without a recession in America. As you're rightly saying, officially the US is already in recession. The reason a US recession historically has been good for India is twofold. One, it conks off oil prices, and two, it brings down the cost of money. The cost of money argument this time round perhaps isn't as powerful because of the inflationary backdrop and the rate hikes in the West, but the oil price relief is already palpable. In the last 4 or 5 months, we've seen crude come off 30%, and courtesy Russia, India has got even cheaper crude than that. So the US recession is not something to go home and beat yourself about and sell Indian stocks. It's actually a bullish argument. And leaving that aside, the local vibrancy of the economy, right? The not just the festive season demand, but the overall tax collection buoyancy, the overall macro buoyancy, to my mind, is plain to see. And therefore, the focus should remain on buying high-quality Indian companies rather than doing some, macro forecasting after reading the morning newspaper.
Hi, Saurabh. Morning. On your point on IT, you have held your stance and, you continue to hold on to that. I think TCS and LTTS, right? Those are the two stocks that you'll have in your portfolio from the IT names. Any change out there?
So both continue. We're looking to add other names in the sector.
Okay.
The challenge historically with smaller names in Indian IT, right? Small and mid-cap names, the challenge is they tend to be vertical specialists. They tend to do one thing well.
Right.
And if they do one thing well, it's actually quite easy for the giants like TCS and Infosys to come and blow them out of the water. And hence, we tend to be quite careful about small and mid-cap IT. LTTS actually isn't an IT services company. It's an engineering R&D provider. It just sort of sounds superficially similar to IT. It's actually a very different type of company to, say, a TCS. But small and mid-cap IT, historically, we've stayed away, and I don't think we'll change our point of view. You're better off focusing on the giants. We have TCS, but as you guys see, Infosys is doing very well as well.
Okay, all right. We categorize it basically as mid-cap IT. So, that's the reason why I asked you under that header. But on the banking space, that's the other pillar for the market. HDFC, Kotak, as well as ICICI Bank, you've been pretty much positive on those three banking names. If we're going to be getting this big credit growth cycle and we're at the start of it, the NPAs as well fall and asset quality is going to look much better, will you go down to tier 2? Will you give the PSU banking names a look, or will you stick to these three names?
No, I think the data in Indian banking actually has been very clear for the last 20 years. It's not a recent thing. The relentless market share gains by the three private sector banks you mentioned, plus the reinvigorated Axis Bank, the relentless market share gains on both sides of the balance sheet is very clear. Whilst it's really encouraging to see what SBI has done in the last 4-5 years, I think Arundhati Bhattacharya's reign and the subsequent SBI recovery has been to see. It's still a company with ROEs which tend to be relatively weak by Marcellus standards, and our focus therefore is on the frontline banking names and the frontline NBFC names. The Bajaj Finance or Chola, both are parts of several Marcellus portfolios. A disclaimer here, I hold these stocks, my parents own these stocks, and our 11,000 clients own these stocks. So obviously we have a vested interest in discussing what we own.
Okay, fair enough. That's on the financial space. The other big piece that is recovering in a huge way is consumption, right? Domestic consumption. Whichever way you cut it, whether it's hospitality, autos, aviation to a certain extent, which is the piece that you would like to focus on now? Because there are, of course, headwinds there as well. I mean, in autos, it's sort of chalk and cheese within the space itself. What are you focusing on?
Sure. So look, I think what's becoming really clear in India over the last 4 or 5 years, I think this was the outlines were there before COVID, but after COVID, it's becoming much clearer that consumption which focuses on the sorts of people who are watching, say, this CNBC broadcast, affluent Indians, upper middle class, salaried SME owners, that consumption piece, as you're rightly alluding to, Sonia, that piece is booming, right? So if you look at cars, they've been doing well. In fact, other than the sort of few dire months of COVID, car demand, auto demand picked up reasonably nicely, but two-wheelers continue to struggle. And then generally, the less affluent strata of Indian society is still under the pump. Whilst people like us are doing well, job markets for formal employment are booming. The informal labor market is still in the doldrums. So our focus in our portfolios is, say, retailers like, say, V-Mart, which sells small ticket clothing items in the district towns of northern India. We also have a Titan in our flagship portfolio, consistent compounders. And our realization has been that if you focus on affluent consumption, right, so an Asian Paints, a Pidilite in the building material side, a Titan and a V-Mart on the retailing side, you carry on benefiting from the growing affluence of the sorts of people who are watching this broadcast.
All right, that's interesting. Saurabh, have you bought anything new within the consumption space? I mean, there's so many, right? I mean, I don't know if you own any QSR names. That's a play on consumption. Anything new across the spectrum of consumption?
QSR, Prashant, we can't find QSR players with strong barriers to entry. There's always QSR itself is booming, but we couldn't find players with barrier to entry. We bought Vijaya Diagnostics, which is a Hyderabad-based regional specialist in radiology and pathology. So we bought that in our small cap portfolio, Little Champs. Vijaya IPO'd not very long ago. I think 6 or 7 months or 8 months since it IPO'd. We spent 3-4 months traveling around Telangana and Andhra Pradesh, visiting their labs, speaking to ex-employees, speaking to customers of theirs. And we believe that in the Telangana-Andhra belt, Vijaya has built a very strongly moated, formidable franchise, very profitable, strong barriers to entry. And that's why in our Little Champs portfolio, we purchased Vijaya Diagnostics in relatively large quantities.
Okay, all right. And I think, Vijaya replaced Gujarat Ambuja Exports, I think. So that was the switch that you had done in that portfolio, if I remember correct. What about the pharma space, Saurabh? There's so much of fear that discretionary spend gets pulled back. Well, this could be an area that's actually, it's quoted. I mean, it's protected from that sort of a fear. The rupee as well fairly weak, and I think the index on the whole hasn't done much in the last few years. Are you looking at pharma? And if yes, any specific areas?
So what's I think happened is the Indian pharma companies who sell abroad, right? The Indian companies who sell formulations abroad, they actually have no competitive advantages whatsoever. So I think that story is very difficult to invest in. Indian companies making formulations in India, selling them basically at hugely discounted prices in the Western world or in Latin America. That's we think is an uninvestable story. In pharma, big holding continues to be Divi's Lab, and we continue to be honestly a little amused at the way other people are selling Divi's Labs. So we are very active by purchasers of Divi's Lab. Divi's doesn't sell formulations, it sells APIs, it does custom synthesis and manufacturing for the world's 6-7 largest pharma companies. Formidable franchise, and we think it'll get plenty of work as the Western Hemisphere shifts API manufacturing from China onto India. Divi's will be a massive beneficiary of that switch. Beyond that, the entire supply chain feeding into APIs, which is saying raw materials like aliphatic amines, where we have alkylamines, the glass-lined reactors, which are used to make pharmaceutical products, where we have GMM formula. We're looking to see if we can buy more things in that supply chain, which feeds into APIs. We reckon the API industry in India will do very well over several years to come, 4, 5, 6 years. I think it's a booming demand scenario. China is 6-7 times larger than India in API manufacturing. A lot of that will shift to India. And therefore, the entire supply chain feeding into APIs, we're very excited about that. Formulations, manufacturing of actual medicines, I'm not so sure that's a very clever place to invest in.
Saurabh, great to have you with us here. It's a pleasure. Thank you very much, as always.